Santa might be refueling because as of now, futures are pretty flat, but we are starting this shortened trading session with a record on the S&P 500. 30 minutes until that start. I'm Vonnie Quinn.
I'm Graffeo. Bloomberg Open Interest starts right now.
Coming up, U.S. stocks hover near all-time highs on this shortened trading session. Traders banking on that Santa Claus rally.
And gold's rally hits a pause after rising above $4,500 an ounce. Silver and platinum also at records.
And finally, Intel dropping following a report that Nvidia has stopped a test that uses Intel technology to make advanced chips.
And as Vonnie mentioned, we're watching shares of Intel right now. Shares down about 3% in the pre-market, with Nvidia recently testing whether it could manufacture its chips using Intel's 18A production process. However, there's a report now that Nvidia has halted the tests. Nvidia and Intel didn't immediately respond to requests for comment.
And also, Emily, as you mentioned, the metals, of course, we're keeping an eye on miners and mining stocks as those precious metals, and not just the precious metals, climb to records. Geopolitical risks driving those prices up. As you can see, this is pre-market trading, so again, not doing too much on this holiday shortened trading day, but we're still keeping an eye on all of those miners for you. Emily.
And Vonnie, for more on Intel and Nvidia, we welcome Bloomberg Markets correspondent Nora Melinda. So tell us about what is driving Intel stock lower right now.
So essentially, Nvidia halted a test run of Intel's 18A manufacturing process, which we know essentially is a process that makes chip making more efficient and faster here. So we do have this being really critical to Intel's turnaround story. So that's what's really alarming investors in this moment, because this is essentially a process that should help Intel compete with a global leader, TSMC. So investors are essentially concerned that this is sparking doubts about Intel's ability to push forward.
Well, how important is Nvidia to Intel here, given that Intel is really trying to build trust again, right?
Absolutely. They are trying to build trust. And if we do flashback, we do know that the government took a 10% stake in this company. We also did have Nvidia pledging about, $5 million, if I'm not mistaken, $5 billion, excuse me, to Intel just back in September. But this is really important to essentially get a co-sign from Nvidia. So Nvidia is not currently a direct customer of Intel. They actually work mainly with TSMC. But the fact that they are actually testing out Intel's 18A manufacturing process essentially gives Intel some validity for its foundry business.
So we know that liquidity is a little bit light today with the thin holiday trading, but the stock did react fairly strongly.
Right.
We're down about 3% in the pre-market. Why do you think the market reacted so strongly to this move, particularly if this isn't a contract that we're talking about?
Right. So it's not exactly a contract, as I was reiterating earlier, but people are really interested in whether or not we can see Intel really making some moves in this environment, given the fact that they do have some global competitors and they have struggled for quite a while. So we really, of course, do see shares up pretty substantially on a year-to-date basis, but we really are looking for a turnaround story when we think about it from the investor perspective. So that's why you are seeing share reaction to the decline, because people are really just concerned about the validity of its business and its efforts moving forward.
Well, and also because, as I remember it, didn't they unveil all of this back in October? It was a huge event, a 3-day event, and didn't they say that these 18A processors that were being made in this fab, they would help pay for Intel's own technology in its laptops that are going to go on sale next year. So
right.
If they're not working, what happens to that?
Right, there's a lot riding on this, Vonnie. Investors are really looking to see demand for this. They're also looking to see some valid customers. Of course, Nvidia is a very marquee name, and so investors are really looking to see how many other major customers they can get and whether or not they're really able to push ahead, especially as we think about this U.S. chip making push that we're really seeing from both the government and a lot of customers right now.
Nora Melinda, thank you for joining us on this Christmas Eve. Have a good holiday. That's Nora Melinda from Bloomberg Markets. Now turning to Washington, a federal judge rules the Trump administration can move ahead with a $100,000 fee on new H-1B visa applications. The ruling viewed as a setback for U.S. tech companies. Joining us with more is Bloomberg Washington Deputy Bureau Chief Laura Davison. Laura, thanks for joining us. Just tell us here just how much of a setback is this for these tech companies that do hire a lot of foreign workers?
This could be a massive setback. This really raises the cost that tech companies and other pharma companies, as well as large American universities, would need to pay to go and bring in some of these highly skilled workers that they need to be able to do the research and development that they're doing within their companies. So this is going to be sort of a key rift between the business community and the White House, which has had pretty close ties, at least so far in this administration. I'll note that this decision can be appealed, so it's possible that this is not the final word on this, but at least for now, this is a huge win for the White House and a setback for corporate America.
And it's coming at a very difficult time, right, Laura? Because many of these visas need to be restamped, if you like, and people, H-1B holders, often do that around the holidays, so many of them could be out of the country. What happens to those?
Yeah, there's been, not a lot of clarity around exactly, what people who currently hold H-1B visas should do. But you've seen a lot of caution of companies warning some of their workers who are not U.S. citizens to go ahead and stay put, not travel, or be very cautious and deliberate about the moves they're making internationally. This is really part of the Trump administration has been trying to essentially find ways to generate revenue off foreigners coming into the U.S. So this is part of a broader strategy we've seen with these golden visas, these gold cards. This is kind of a different tack than previous administrations have taken.
And Laura, talk to us about the process for an appeal. How likely do we get the U.S. Chamber of Commerce making that appeal? And then what would the timeline be for when it actually happens?
Yeah, so it's not exactly clear, both the likelihood and the timeline here. I'll note that, these things tend to move slowly through the legal system. The real question we're looking for next is if there will be some sort of injunction or if some court will come and say, look, we need to put a pause on this while this winds its way through the courts, or if the administration goes ahead and immediately starts charging this $100,000 rate. So those are the kind of key details. Not exactly clear if we'll see that, but early in January, there should be some clarity on whether this is proceeding or will be mired in the legal system for longer.
Laura, thank you so much. That is Bloomberg's Laura Davison there. Well, the bullish sentiment heading into the new year is worrisome for some. Equity forecasters issuing year-end targets for the S&P 500 that are clustered the tightest in almost a decade. We're joined now by Bloomberg cross-asset reporter Isabel Lee. How has this happened, Isabel, that we're at the tightest cluster in a decade for all of these forecasts?
It's interesting. We have the bullish one at Oppenheimer at 8,100 and the most bearish is Stifel at 7,000. So that gap is just around 16%. And usually, if you're at this clustered, it's a contrarian signal because if everything is present to perfection, things will likely go wrong. I mean, we still have a lot of uncertainties next year, whether geopolitical, inflation is still ticking higher. I mean, it has cooled down in the recent report. Unemployment is still edging higher. And we also have this whole AI rally that has yet to be monetized by these companies. So still a lot of uncertainty.
The fact that everyone on Wall Street is having a pretty consensus view then. Why is that? Is there just more uncertainty, or investors are not really wanting to go out on a limb and make a big call because you really don't get paid that much for doing that right now?
It could be that. I mean, they still predict an 11% rally next year for the S&P as a group, which is really spectacular because we've seen the S&P rally for 3 straight years now. We're on track for the 3rd straight year. So we do have that optimism, but this is kind of like Alex Savanova is the one who wrote this story, and she tracks this space closely. She said it was a necessary evil yesterday when we were chatting because you do have to put out these numbers. But then through the year, next year, trust me, you will see one after the other a revision, whether upwards or downwards. It's just more the direction, actually, rather than the numbers. So for now, the direction is bullish.
What's happened in previous years when this has happened? I mean, we may as if we're going to depend on these forecasts, we may as well look at what happened next. I mean, did the stock market then fulfill some of those forecasts?
No, there was an interesting stat from Piper Sandler. They said that targets for the S&P tend to trail the actual index performance by 2 months. And last year, especially this year, I'm already in 2026. This year, during the April volatility, a lot revised lower their targets because when you're in the face of a huge market rout, it's a question of your conviction. And so they revised lower. And then so we actually admired those who really stuck to their guns. One of those was Chris Harvey. He used to be with Wells Fargo. Now he's with CIBC. But there's also the premise of it's not even about getting the number right, but it's just holding on to it. Because if you keep on revising, I mean, just like in life, if you keep revising and if you waver back and forth, people kind of lose respect for you in a way. That's
Okay.
kind of harsh.
So those are the numbers. Was there any consensus on just what factors are actually, in the macro, going to drive the S&P higher this year?
It's still predicated on the fact that growth will be powered by corporate earnings, that when the Fed rate cuts, markets will rally. We have tax and regulation changes in the government. People are expecting that will spur the economy and make it more robust. So I feel like as much as there are uncertainties, there are still some reason for optimism.
Well, I'll tell you one thing that's certain is that you are going to help us through it next year. Isabel Lee, they're always with us to help us understand what's going on in these markets. And speaking of markets, let's get a check on those futures because we've 21 minutes to go and at least we have now turned green, albeit very, very fractionally green on those futures. If we take a look at bonds, those yields going nowhere after the initial jobless claims data. Bitcoin still trading around $87,000 a coin. And then, of course, we have to look at gold. It's just $12 off that $4,500 mark, which it did bypass earlier today. Now let's get a look at some other movers on our radar. Nike shares gaining in the pre-market after a filing showed that Apple CEO Tim Cook purchased almost $3 million worth of shares on December 22nd. Cook is Nike's lead independent director.
And Dynavax is jumping after Sanofi said it's buying the biopharma company. The deal is worth $2.2 billion and part of Sanofi's efforts to expand its vaccine business.
AST Space Mobile is up in pre-market trading after launching its largest ever satellite from India. The company is looking to compete against SpaceX in delivering space-based connectivity for mobile phones. Well, coming up, we break down the economic data this week from that GDP print to jobless claims this morning. That's next. This is Bloomberg Open Interest. Now to high interest, a look at what's making headlines around the world. A Texas power developer is proposing to repurpose nuclear reactors from Navy warships to power the U.S. grid. This comes as the Trump administration pushes to secure massive amounts of energy for the AI boom. The project would produce up to 520 megawatts of electricity, enough to power roughly 360,000 homes. Ukraine's President Volodymyr Zelensky says that the US and Ukraine remain split on territorial issues when it comes to finalizing a peace plan to end Russia's war. Ukraine is rejecting Russia's demand to give up land in eastern Donetsk, fearing it would leave the country vulnerable to a new Russian attack. BP has agreed to sell a majority stake in its Castrol division to U.S. investment firm Stonepeak Partners. It's an effort to reduce debt and reset its business. The UK energy giant will raise about $6 billion from the sale of a 65% interest in Castrol, which includes some prepayment of future dividends on its remaining stake. The sale brings proceeds from BP's asset sale program now to about $11 billion, with all proceeds from the disposal to go towards reducing debt, according to BP. That stock is down in pre-market trading. Emily.
And it may be a short trading week, but there was plenty of economic data this week with a surprising GDP number and jobless claims today. Joining us now is Bloomberg's Katerina Saraiva, who covers the Fed. All right, Katerina, we're going to start with the eco data that we got today, the labor market. The jobless claims miss. How much can we read into this? Is it a sign that the labor market is weakening, or is this more just seasonal volatility?
I think it's more seasonal volatility, especially at this time of year. You're going to get a lot of ups and downs in these numbers as people are hiring for the holidays, but perhaps just on a temporary basis. So you are going to get a lot of seasonal volatility in those. But I think overall, if you look at the broader trend of jobless claims over the past few months, it's kind of reinforcing that low hire, low fire environment that we just continue to be in.
Yeah, John Riding just out with his note from Breen Capital. Katerina saying, listen, jobless claims have shown no meaningful increase in layoffs in the whole of 2025. And moreover, the 4-week average is below the average for 2025. Does this mean the Fed is free to do nothing in January and maybe even beyond?
I think it certainly kind of bolsters the case for them to perhaps keep rates on hold at this point. It seems that they're leaning in that direction anyway. They delivered 3 rate cuts this year. That came after a full percentage point of cuts last year. So I think, it sounds like they're kind of ready to perhaps take a pause. And data like this that kind of keeps things steady right now in the labor market will certainly support that.
What about the big GDP surprise to the upside that we got just the other day? How much does the Fed take that into account for the January meeting, considering that it was somewhat backward looking?
Yeah, I mean, you're right. It was pretty backward looking, right? It's for the third quarter of 2025. But I think it will, what it will do is kind of lend a bit more confidence to the more hawkish faction of the Fed, the people that were already starting to get really reluctant about some of these rate cuts that we had this year. Those Fed officials will probably feel a bit vindicated in that position and will feel even more apprehensive about cutting further, because that data really showed that the economy had quite a bit of momentum, especially from the consumer. And that's where you can really start to get some inflationary pressure.
Katarina, we do have a 7-year auction at 11:30 a.m. Eastern. Will we know anything from appetite at this particular auction, given how low liquidity a day it is?
Yeah, I mean, it's a tough day, right? Christmas Eve, it's really coming right before Santa's supposed to be delivering our presents. So I think it's a tough day for anything like that. I don't know that we can really take a lot of signal today from anything that's going on in the markets. So we'll just have to see what happens.
Okay, it is Christmas Eve. The consumer is definitely on the mind, Katarina. You had mentioned the consumer and potentially inflationary pressures picking up. Just talk to us about kind of what economists are expecting for next year when it comes to the consumer. I'm hearing a lot of people say K-shaped economy.
Yeah, that's right. I mean, I think economists are optimistic in general when you look into next year. Of course, we're coming off a year with a fantastic stock market, right? We saw those new records yesterday. And that's really bolstering spending, especially at the top end. For the lower end of consumers this year, especially the end of this year, has been rough. We've seen spending really come off for those folks this year. So into next year, it's really going to have to depend on what happens. I think there's some optimism that maybe some of the tax legislation that we had this year could help, on in terms of no taxes for overtime pay and tips. Something like that could maybe help people on the lower end. We'll just have to see if it really makes a dent and makes a difference for those folks.
Katarina, prepare us for next week, because it feels like it should be an even quieter week, but we do also have some more releases, including the FOMC meeting minutes. Will there be anything we should be watching out for?
Yeah, I think what I'm really going to be looking for in those minutes is further signs of this growing disagreement among Fed officials. We've clearly seen that there's a pretty big split among those that are really ready to not raise rates anymore and those that still want to cut rates anymore, and those that want to keep cutting. So it'll be interesting to see just how that was talked about, how that was discussed at the last meeting, whether people expressed concern about certain parts of the economy, about what's going on in the labor market, whether there was more concern about inflationary pressures, whether that cohort is growing in numbers. So I think there'll be a lot to read through, and it may give us some hints about what's to come at their next meeting, which of course is at the end of January.
All right, Katarina, thank you so much, and for all of your context all year. That is Bloomberg's Katarina Saraiva. Let's get a quick check on futures now. Just a few minutes before the opening bell, we flipped negative again, at least for S&P 500 futures and Russell 2000 futures. Don't forget the Russell 2000 had been outperforming, but we've been pipped at the post. The Nasdaq 100 doing well after the SOX had its last 4 days of a rally, more than 7% of a rally for those chip companies. We'll see how things do today, but we're effectively unchanged. Coming up, a look ahead at how markets are moving this morning with Nimrit Kang of Northstar Asset Management. This is Bloomberg Open Interest.
time to dust off the old adage, which is respect the trend, but don't ignore the risks as we go into 2026. It could be in an environment where we're still able to carve out new highs because of those earnings estimates, but there could be some volatility and chop along the way, simply because you have a high bar with valuations and a high bar with expectations as well.
And that was New Edge Wealth's Cameron Dawson speaking to Bloomberg TV earlier this morning. Joining us now is Nimrit Kang, Northstar Asset Management Chief Investment Officer, to talk about markets and the outlook for next year. So Nimrit, AI, that was really the trade of this year. Is that what continues next year? Is that where we want to be?
Well, AI has definitely been the trade, not just of this year, but really since 2022 when we had ChatGPT. Something like, 2/3 of the market returns have come from AI stocks, almost 80% of the earnings. And even if you look this year, you look at something like the semiconductor index responsible for 60% of the earnings growth, whereas you're seeing other sectors, industrial, staples, so many of them just lackluster, a couple of percent earnings growth. Now, does that continue into next year and onwards? There is this case for AI so far has been just focused on AI builders. The question is, do we move into companies that can actually monetize AI by incorporating into the businesses for both cost savings and revenue generation? We certainly hope so. That's our base case, that we're going to start to see a broader basket of AI beneficiaries in 2026.
And I know you're calling it the year for rebalancing towards the have-nots. We're going to dive much more into your views in just a few minutes, Nimrit, but we're going to get the market open first. Nimrit Kang of Northstar Asset Management is sticking with us. So let's get a check on those futures now, just less than 5 minutes before the opening bell. And we have flipped negative once again. As I said, Santa must be refueling, because we certainly have had some nice days of gains over the last several days. That Santa Claus rally was well in effect. Dip buyers emerging. The SOX index was up more than 7%. We had the S&P close at a record yesterday. In fact, all of the indices, the Nasdaq 100 up 21% plus so far this year. Even the Russell 2000, while it had been a laggard, it's been doing well in the last few sessions. It's up 14% year to date. So we're going to take you to the market open, the final one before Christmas at least, in just a moment. This is Open Interest. Moments away from the start of trading. This is Bloomberg Open Interest. I'm Vonnie Quinn. Let's take a look now at what we are watching. So the NYSE trading floor operations team and the trading operations teams ringing the opening bell today, and we wish them all of the best. In fact, the facilities teams are going to be doing the closing bell. Meantime, let's take a look at where futures are. Oh, look at that. Beautiful picture of the Girl Scouts of America ringing the opening bell on the Nasdaq. That is the new CEO there, Shari Kroll, just having a nice morning with all of those Girl Scouts who no doubt are going to turn into traders of some kind. We have no doubt about that. Emily.
You gotta love the Girl Scouts and then the Santa hats on the trading floor. We're also watching shares of Intel. That stock down about 3% after Nvidia recently tested whether it could manufacture its chips using Intel's 18A production process. However, there's a report that Nvidia has halted the tests. Nvidia and Intel didn't immediately respond to a request for comment.
And we're keeping an eye on miners and gold as well, as precious metals climb to records. Geopolitical risks driving those prices higher. Not just gold, but of course we've seen silver, we've seen palladium, we've seen platinum. Some of the industrial metals also climbing to records. And we're back with Nimrit Kang, Northstar Asset Management Chief Investment Officer. So Nimrit, we were talking about pivoting to the year of have-nots. It feels like it might be difficult in a market like this to find the have-nots, but there is a rotation trade ongoing. So where are you looking for some of those?
You're right. We've started to see a rotation trade starting in November where, some of the laggards, all of a sudden you've seen money flow out of the tech winners, out of the AI winners, and flow into some of these laggards. You've seen healthcare, industrials, pretty much a lot of the companies and stocks that didn't participate in 2025 kind of see some of that capital flow towards them. Now, the question is that temporary because of tax loss harvesting, or do you kind of see this more sustainable? Our base case is that we will continue to see this rebalancing go into 2026, just because there's enough anxiety about the market concentration and being really focused on just that narrow segment of the market with the Mag 7 and the AI winners. And if you really believe that there, the GDP print that we got yesterday, that this is going to be a broader recovery, then there is a solid case for all these other companies to start participating as well.
Nimrit, I feel like, we had this conversation last year too, right? We were wondering if this AI rally could continue, and it continued through the whole of 2025. It was really only towards the end of 2025 that the circular financing worries really got under the market's skin.
Yeah, you're absolutely right. Even as I'm preparing for it, every year we write the same thing. The market's too concentrated, it has to broaden out. And yet, again, we find ourselves in the same situation year after year. What I think is different, if you look at the GDP print from yesterday as well, we actually see a rebound in industrial production. Industrial production has been pretty stagnant over the last, I would say, several quarters, even going into several couple of years. And we did see that rebound and pick up. So I think there is a case there for that. The second thing, Vonnie, that gives us some hope is that coming into 2026, we are going to start seeing some stimulus help for, and more money into the pockets of the low-end consumer, the low-income consumer, through those tax refunds and so forth. So those are some of the things that I would say are different versus what we've seen coming into this year.
How much of the broadening out of the rally really depends on the labor market here? Because we did get jobless claims this morning that did miss estimates. And of course, the Fed is very focused on the job market.
Yeah. It's a very fractured labor market in some ways. There is a bit of what we call a skills gap going on as well, because as the economy is changing, becoming a lot more leaning into AI and the new skill set, there's going to be a transition phase, the digestion phase. On the other side, there's a structural shortage of workers, not only related to secular trend of aging demographics, more and more people are retiring, but also because of the immigration clampdowns. So the supply is lower as well. And we think that, because of that, there is support for the labor market going forward as well. But on the margin, there has been some weakening without a doubt. You see that very clearly in the data. But I think that's more related to just this transition period for not having the right skill set.
Okay, so a broadening out in the equity portfolios. How are you thinking about bonds for next year? We have corporate credit spreads at historically tight levels, and they only seem to be getting even tighter. Do you buy corporate bonds? Do you stick in treasuries for next year?
Emily, it's kind of like, there's a credit debt problem no matter where you look. The government with a fiscal deficit, 6.5%, very high. You look around that corporate debt, again, with all this participation related to AI financing, there's a case that maybe that's not the safest place. But I think when you look at the spreads, you are constantly thinking about what's the upside and downside. Sure, the spreads can go lower from here, but are you getting paid to take on that credit risk? Not necessarily. So we would stick with high quality. But, again, as a balanced portfolio, we're taking a lot of risk, the credit risk in the equity side as well. So we would stay away from that on the debt side. In terms of looking at the fixed income overall portfolios, we are constantly trying to strike a balance between reinvestment risk, which is at the short term with the pressure to cut rates, and the longer term where there's a price risk, because we do think there's a case for higher for longer. So our sweet spot remains in the belly of the curve, in the intermediate duration, because that's where you can strike a nice balance. And, at the end of the day, you're getting the 4.5% yield on fixed income, which is, not bad compared to where we've been. And so we would stay balanced in that range.
Nimrit, are you at all concerned about private credit creating problems next year, or indeed any part of the market creating unforeseen problems?
Yeah. The problem with private credit, it's debt, but with less transparency, less regulation, less visibility. And that creates problems by default because we don't know how much, where, who are the counterparties, how does that all come through? So we do worry about that a lot. And especially if you think about the rush that's gone into private credit underwriting over the last couple of years as investors have sought to seek that yield, we think there's a case that you're going to have a relaxing of credit standards and so forth, and that is going to trickle down at some point. We just don't know when. Right? We don't know when. Does that happen? Does that become a 2026 or later? We don't. We've had a few of those, the famous cockroaches analogy that Jamie Dimon made earlier with the several of the bankruptcies. We don't know how that's going to show up and if it's going to really become a broad-based issue. It feels like not yet.
Nimrit, thank you so much for joining us on this holiday shortened trading day. That's Nimrit Kang of Northstar Asset Management.
Let's get a check on the stock market now and where we are trading. So there are not too many catalysts today, but we do see some stocks higher. In fact, Nike is one of the better performers, up more than 4%. Apple, as you can see, Eli Lilly is doing well. That's possibly after the Novo Nordisk news yesterday, that pill coming out, and Eli Lilly's pill is going to be coming out in just a few months. We have Costco up. That's on an upgrade that we saw earlier. Merck again. You see the consumer, the biotechnology companies doing extraordinarily well. And then on the downside, we do still have some of those chip companies and some of the Mag 7 just down a tiny bit. But bear in mind, they have had a good run up the last few days. So perhaps this is just some profit taking ahead of the end of the year. And of course, that Santa Claus rally has done nicely for people. Let's take a look at the groups, because as I said, the healthcare index is the best performing index right now. Some of those stocks, including Lilly, higher. Consumer staples as well, real estate, some of the unloved indices, if you like, that haven't really seen too much action over the past few days. And then you've consumer discretionary, utilities, materials. But as you can see, not a huge amount of movement today in spite of all of this liquidity coming into year end. We have a shortened trading session, so perhaps people have already taken the day off. Emily.
Coming up, a preview of what we can expect from M&A in 2026. This is Bloomberg Open Interest.
A check on stocks now. Look at the S&P 500. It's only up less than 3 points, but don't forget we closed at a record yesterday. So if this finishes in the green at all today at 1 p.m. Eastern, then we've set another record for the year. Plenty of stocks moving higher and lower underneath the surface in that index. Nasdaq 100 down just 5 points. The Russell 2000 is the worst performer today, but don't forget it's been doing pretty well. It's been outperforming the other two in the last few sessions, up about 14% year to date though. Now, time for our top calls. Some of the analyst action in focus this morning. First up, it's Costco. That got a buy, an upgrade from neutral at North Coast. The retailer reported earnings and sales that topped estimates for the quarter earlier this month. The price target set there was for $1,100. Next up, Raymond James cut KB Home to market perform. The analyst cited the company's disappointing fourth quarter results for the downgrade. And finally, Dynavax cut to market perform at William Blair. That's after, though, Sanofi announced it's buying the company for $15.50 per share. The analyst says the acquisition, quote, makes sense, while citing regulatory concerns around vaccines.
Well, the deals struck in 2025 are offering early signals of where M&A is headed. Executives are weighing rate cuts, election fallout, AI-driven consolidation, and growing pressure to deploy capital. Joining us now on what to expect for M&A in 2026 is Bloomberg's Fareed Zaloul. So talk about what exactly is going to drive what could be a banner year for M&A next year.
Yes, thanks for having me, guys. So I think what we can expect next year is probably very similar to what we've seen this year, right? It's been around 4.7 trillion of total deals value announced. That's the second highest on record. And what's been driving that is a proliferation of mega deals. A lot of that has been tied to the AI boom, which is touching every sector. We've seen the return of Wall Street writing some massive financing checks on the biggest deals. Sovereign wealth funds from around the world are getting involved. And these conditions are, as I said, rolling us into 2026, and lots of the bankers are talking about a record.
Yeah, I mean, so with all of these AI deals, it's hard to remember that there were actually sort of regular deals done as well. I mean, remember Foot Locker bought by Dick's, and then there was the rails, remember, yep. Union Pacific bought by Norfolk Southern.
Yep.
Or the other way around.
Other way around.
Thank you. That's very kind. But on these AI deals, can more get done, or does the market have appetite for that?
It seems so. Yeah. I mean, this is a rapidly expanding ecosystem around AI, right? And as I said, it touches every sector and every deal. It seems. I mean, if you look today at BP's sale of its stake in its Castrol lubricants business, right? This is a very famous brand, makes lubricants for the aerospace, marine, auto sector. At first blush, doesn't look like there's any kind of AI involvement, but they've also been starting to move into
data cooling.
Data cooling, yes. And so BP's retaining a stake in that business. That could give it some exposure to an upside there. It really is everywhere. We spoke with some senior bankers recently to get their predictions for 2026, and one of the top tech deal makers at Morgan Stanley told us everyone has to be an AI banker right now.
We have to ask you about your insights on what could be one of the biggest media deals of all time, not just of 2025, 2026. Warner Brothers, Netflix, Paramount. Just in the next week or so, do you expect any incremental news?
I'm praying no, because I would like some time off over Christmas. The evidence up to now suggests that may be wishful thinking, but we'll see. Lots of the news in the last week has been around Paramount. I think something that's worth repeating is they have a deal in place with Netflix, right? Netflix has agreed a deal for Warner Brothers. It's $83 billion roughly. They take the studio business, the cable stuff gets spun off. Paramount wants the whole thing. Warner Brothers last week rejected its proposal, and it's come back with some remedies this week, particularly around like backstopping the equity financing portion of the deal. That's now where we are kind of in terms of each side of that. And I think Warner Brothers and its investors will hopefully take some time off over Christmas to digest this.
I don't know if you've had a chance to speak to M&A bankers today at all, but what is anybody making of this FT report that this AI debt has been kept in special purpose vehicles for the most part, and that there's $120 billion worth of it sort of off balance sheet? I mean, that's a little bit concerning, right?
Well, I think that generally a lot of the risks around M&A next year, what could kind of torpedo this, a lot of it is tied into AI just in general and whether there's a bubble forming here, right? If you look more broadly around concerns of a stock market correction, given how much tech drives the stock market, that's also tied into AI. So really, I think when you speak to bankers about the risks of 2026, I mean, they're generally a super optimistic bunch, right? But they do say potential AI bubble, potential stock market correction, that could derail an M&A recovery. But if you look at what happened after Liberation Day, that was a massive stock market correction. Everyone thought, myself included, forget about it, right? M&A's dead, and off it went.
Yep.
So,
what are the bankers saying about the regulatory environment for next year? Because there was a lot of excitement that deals were just going to get done with the Trump administration. And we were off to a bit of a rocky start, but it seems like activity is now picking up.
Yeah, this is another thing that gets mentioned constantly by bankers, including some that have been on Bloomberg TV recently. They say that companies feel that now is the time to strike, right? You've had these really ambitious deals that you've wanted to do for years. You felt that previous administrations have not given you the room to do that from a regulatory standpoint. Now you have that, let's get it done. And, questions about what could come further on up the road after Trump and what future administrations might do. It doesn't seem to be, I mean, I'm sure it is in some level, but right now the appetite is just, let's just get it done while we can.
And you mentioned Morgan Stanley there. Number 3 in the league tables. I was looking this morning at LEAG. Goldman and JP Morgan at 1 and 2. Our thanks to Bloomberg's Fareed Zahlul there joining us. Coming up, it's been a big year in ETFs as well, but it's unclear whether next year will be as record-breaking. We'll discuss next on Bloomberg Open Interest. This is Bloomberg Open Interest. A check on stocks now. You have 3 hours and 10 minutes to go in this shortened trading session. And we are continuing on as we have been going over the last several sessions. The S&P 500 is higher. It closed at a record yesterday. Nasdaq is just fractionally lower. Russell 2000 as well. The VIX, which closed at 14 the other day, which was a record low for the year, is even below that now, below 14. We have gold just off its peak. It did top $4,500 an ounce earlier. Obviously, a little bit of profit taking there. And the dollar index, a little bit of weightiness to that. We saw big movements with the yen, the South Korean won today, and other currencies. Nvidia and Intel, this is a Reuters report that the Intel A18 technology may be not as interesting as Nvidia was hoping for, that it might have stopped using the process. We haven't heard from either company, so let's just wait on that. But remember, Intel did tout that in October as its big savior. Nike up 4.3%. There's a report that a certain person at the head of Apple, Tim Cook, bought some shares, and that might be enough to be sending that stock higher. Dynavax, of course, getting bought by Sanofi, and that's up 39%. Don't need to go through everything, but KB Financial got an upgrade, and BP also involved in a deal today, Emily.
All right, well, we still have a little bit left to go in the year, but so far, 2025 is set to be a record-breaking one for the ETF industry. We saw record flows, launches, and record trading volume, but whether that holds up for the coming year is up for debate. For more, Athanasios Sarafagis, Bloomberg Intelligence ETF analyst in the office on Christmas Eve, will make that known. So, thank you for joining us. Tell us about whether we can see another year of record inflows. Do we need a stock market rally again, another double-digit gain in the S&P to power that?
Yeah, I think we need a few things. It's going to be really tough to top this year. Obviously, the market's being good, the launches, more issuers coming into the market. I think we'll probably have a really good year next year just because the shift in ETFs is very secular. It's the market performance matters, but everything's just moving towards ETFs. So I think it's still going to be really good, but I don't know if we're going to have a year that we're going to have like we had this year just because everything was hitting its stride perfectly.
Athanasios, how many went out of business this year, and were they the more risky ETFs?
So we had 1,000 launches against maybe 200 or so closures, which sounds like a lot, but that ratio is still very much skewed in favor of launches. But I think to your point, if things don't raise assets, in a couple of years we're going to have an uptick in closures, just because everyone threw a lot of product out to the market this year. In a couple of years, they're probably going to go through like a rationalization process. So I think maybe in a couple of years we'll see closures come up if they don't kind of pick up assets.
What did we learn, or what did ETF issuers learn from the products in 2025 that worked and then the products that didn't work?
I think this year you have to go crazy, because given how insane this year has been, Vanguard also had a record year, right? And Vanguard is the most plain vanilla firm out there. So I think issuers are finding that if I want to compete in this industry, I need to stand out from Vanguard. And the way you do it is just going to be loud. And every firm's trying to be louder than the next one. So I think this year was just about who can have the most leverage, the most income, the most derivative usage. So I think that's what they're learning. But again, these aren't products that necessarily might fit into your core portfolio. They're always going to be a satellite position. But I think it's next year who can be the loudest, right? Whether it's in private equity or something like that.
Beyond the big ones, the S&P ETFs and the Nasdaq ETFs and so on, where did the flows go in terms of the other ETFs? I suppose I'm wondering if those double leveraged ETFs got a lot of percentage points.
They did. I mean, they get a lot of attention, but for given how small they still are, they definitely punch above their weight. Just because there was a very much risk-on environment this year, there's a lot of buy-the-dip behavior, so all that money just tends to flow towards those single stock ETFs. But international actually had a decent year too. Usually U.S. investors kind of shun international, but just given how well it's performed this year, they actually got some pretty decent inflows as well.
And BlackRock's Bitcoin ETF, right?
Yeah, you forgot about that one. But obviously Bitcoin had a big year too. Even though it's been down this year, it's still taken in inflows. So that's a pretty interesting feat too.
And we're definitely not going to see those 5 times levered ETFs, are we?
No, the SEC stopped that, so maybe just in time.
Can you believe that? I mean, there's so much repetition and sort of, repeating of products on Wall Street, and people were actually going to try and issue these 5 times levered ETFs, Emily. I mean, I'm stunned that they even thought they had a chance.
It keeps it interesting to write about, I will say that.
Yeah, for sure, for sure. Well, Athanasios, thank you so much. He is going to join us again throughout 2026. That's Athanasios Sarafagis of Bloomberg Intelligence. So today is a bit of an outlier, but what's interesting, Emily, is that we have a full day of trading on Friday. So the 27th is actually, market closes at 4 p.m.
That's right. And next week, there's another full day of trading besides the New Year's Day holiday.
Right. So the liquidity that we're seeing, it may not dry up completely, and the Santa Claus rally, which seems to be taking a little bit of a pause today, might just kick into gear once again next week.
I'm still waiting for more M&A headlines. We were just talking M&A, and Fareed is trying to have a day off, but I have a sense that the M&A bankers are working.
Well, the last 2 days have been incredible. I mean, the Sanofi and the BP news this morning. I mean, they were trying to get that done before the end of the year so they could get some kind of rest. But we'll see if we get something, into next week? I mean, both of those obviously involved companies out of Europe. So actually, Europe,
they not celebrate
take more vacation than we do.
Exactly.
All right, coming up in the next hour, an interview with the RealReal president and CEO. This is Bloomberg Open Interest. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest, a shortened trading day, of course, because the equity market closes at 1, the bond market at 2.
I'm Emily Graffeo. This is Bloomberg Open Interest.
Yeah, let's take a look at those markets now, Emily, because we are seeing just very fractional gains for the S&P 500. But if you actually look at the underneath the cover, you're seeing 312 stocks higher versus 186 lower. So traders banking on that Santa Claus rally.
And we also have stocks hovering near record highs. The bond market not really moving much at all today. Yields pretty much flat. And gold's rally hits a pause after rising above $4,500 an ounce. Silver and platinum also hitting records.
And we look at the haves and have-nots of retail, plus the appetite for luxury goods. The RealReal CEO, Rati Sahi Levesque, joins us this hour. Well, in the last hour, we spoke to Nimrit Kang, Northstar Asset Management Chief Investment Officer.
AI so far has been just focused on AI builders. The question is, do we move into companies that can actually monetize AI by incorporating into the businesses for both cost savings and revenue generation? We certainly hope so. That's our base case, that we're going to start to see a broader basket of AI beneficiaries in 2026.
Joining us now is Margie Patel, Allspring Global Investments Senior Portfolio Manager. Margie, thanks for joining us on this Christmas Eve holiday. So what do you make of this idea that we're going to see a broadening out of the rally? Does that mean that you pivot outside of the winners of this year and buy maybe some of the unloved market stocks, or do you stick to what worked?
I think you have to stick with what worked in 2025, technology, strengthening the electrical grid expansion, industrial companies that relate to aerospace, defense, and the higher capex we're expanding. So I really don't, and with modest economic growth, I think you have to say the winners are going to stay winners. And so I'm not really looking for broadening out, because I'm not seeing a broadening out of accelerating earnings from those other sectors that lagged this year.
What about the fact that we did get a GDP print that surprised to the upside in a way that a lot of people weren't expecting? Do you take that as more backdated? How do you kind of incorporate that into this idea?
Well, we may see that revised down a little bit, but it still says the economy is in very good shape, very well balanced, except maybe for housing was continues to lag. And I think that says the momentum will continue in the fourth quarter and also in 2026, which we're now right approaching. That says to me that we'll have strong momentum into the year, plus we'll benefit from lower withholding, higher refunds, and the tax benefits for capital expenditures here. So it says to me that 26 is setting up to be a surprisingly good year.
Now, Margie, some of your top holdings in the last year were Micron, AMD, Broadcom, Nvidia. I mean, we've seen huge gains for some of those stocks, and congratulations on being early, at least, to some of those that weren't as loved as maybe the Nvidias of the world. Do you stick with those particular names, or do you pivot slightly?
Well, I think those names that you just mentioned have all shown continuing strength. They're on the right side of the artificial intelligence boom and just the general increase in technology. So I think those are the ones that are going to stay the winners. And we've already seen that some of those, Nvidia is a great example, where the stock has reported great earnings, but the price-earnings ratio has actually moderated and actually declined a little bit. So you could say some of those stocks are actually a better bargain today than they were, say, 4 or 5 months ago, when they had a higher PE. So we think they're still the winners, and they'll still stay the winners.
That's fascinating. So when you say you don't expect the stock market to broaden out materially next year, do you not buy that this rotation trade is underway?
Well, we've seen here and there, for example, healthcare has had a move in some of the stocks. So we think that, of course, you're going to see winners in any particular sector. But when you look at the broad sectors to say which has sustainable growth above the average in the economy, and you really have to come back to those same sectors that we know have not just growth in 26, but multi-year above average growth. So that's why we think it's better to stick with those, even though, as we've had this year, we've had some real volatility in some of those chosen winners. But we think they're still going to have the earnings power, so we still think they're the best place to be.
So your Allspring Diversified Capital Builder Fund is beating the S&P 500 year to date. That's pretty tough to do. Most active managers don't beat the index. What did the investors who missed the index, underperformed, what were they not getting this year that was clearer to you?
Well, I think one thing, I think a lot of people like to be closet or quasi-indexers. They like to have some exposure in all the sectors, even if they're not convinced that they're going to outperform. And really, the fund that I'm managing is focusing more on a more concentrated approach, sticking with sectors that we think have above average growth, frankly. And also, I think we all like a bargain. I like a bargain, too. And so I think that when you look at a sector that's so cheap, it's irresistible to buy some thinking it has to go up, and it's not going to go up unless it has the earnings power. And so I think that's why a lot of those names have just, chugged around and haven't really done anything, and the winners have kept on being winners.
We have to ask you a credit question because you spent a large chunk of your career in high-yield bonds. Are you concerned at all about those cockroaches maybe spreading in 2026 and that affecting the stock market?
No, I think that, anyway, I think the cockroaches are not in the public high yield bond. I think they're in the other parts of the market, say the private credit and equity sector. If you look at high yield defaults, they've been running about 2%, which is just about the historic low. And if you look at, say, private credit, those defaults are running around 5%. So it makes the high yield market, the yields are down, but it looks probably as safe as it's ever been for an investor who wants a little bit of yield. Problem in the high yield market is you're not getting very much yield. Most of the bonds in the high yield universe are trading above their face value, so you won't be able to get the capital appreciation that we think we ought to get in high yield bonds.
Yeah, it's looking like the high yield corporate index is about 6.6% right now. Is that right, Margie? And what would you want? I mean, what would be a better price for you?
Well, really, if you look at, say, double B bonds, they're around 5.5. The single Bs, as you indicated, around 6 3/4. But again, about all you'll get is a coupon rate, since most of the bonds are trading above their face value and are likely to be called in a couple years. And so you won't really get to enjoy any capital appreciation if the company does better and gets upgraded. So it's really more for the extra little bit of yield. Some people simply want the extra yield that's not available in stocks. Average dividend in the S&P is a little over 1%. But as far as competing with equities, I don't really think it's possible. I think, as I said, the high yield market is in better quality shape than I think I've ever seen it. So for the modest little bit of yield that you get, I think it's a good buy, but nothing that will compete against equities over the next year.
What's your expectation for Fed policy next year? How many rate cuts do we really need to see the S&P 500 continue to rally like it did this year?
Well, we've really had just modest cuts recently and the prospect of very, very modest cuts next year. So I would almost say it's, I think, kind of irrelevant if the Fed cuts another 25 basis points or 50 basis points over the next 6 months, because we can see that the economy is growing at this level of short rates. And also corporate profits are very, very good, far above the GDP growth. Even in this quarter, corporate earnings were over 9%, and profit margins, which is even more important than short rates, are about 16%, so very near their highs. That says companies have pricing power, so they're not going to get their margins squeezed, even in a low-growth economy, which is basically what we've been for most of this year. If you look, especially in the first half of next year, I think we'll continue to see above-average growth at 3% or plus, and so that says to me that corporate profits should be in double digits, and that says we probably will see stock prices more or less mirror that and be double digit. No PE expansion, but at least the earnings will be enough to make stocks pretty attractive once again next year.
Margie, it is always a pleasure to speak with you. Thank you so much. That is Margie Patel of Allspring Global Investments, and thanks for the entire year. Looking forward to speaking with you again next year. Let's get a check on these markets now, because we're about a half hour into the trading session and just less than 3 hours to go for this particular shortened trading session. And we are positive about 0.1% on the S&P 500, very fractionally on the Nasdaq 100. Nike leading the pack, up more than 5%. Interestingly, SanDisk up 4.6%. It is the memory chip makers that have done the best this year, actually. I was checking, and Western Digital, one of those, up almost 300% at this point, and Seagate as well, Emily, up more than 250%, and they're up again today.
Let's get a look at some single stocks moving at this hour. Nike shares are gaining after a filing showed that Apple CEO Tim Cook purchased $2.95 million worth of shares on December 22nd. Cook is Nike's lead independent directors. And Dynavax is jumping after Sanofi said it's buying the biopharma company. The deal is worth $2.2 billion and part of Sanofi's efforts to expand its vaccine business.
And Intel shares dropping after a report that Nvidia stopped using Intel's production process to make advanced chips. Coming up, gold rose to an all-time high above $4,500 an ounce. Copper and silver also breaking records. What's behind this metals rally? Next, this is Bloomberg Open Interest. Now to high interest, to look at what's making headlines around the world. Residents of Southern California are bracing for a powerful winter storm forecast to bring dangerous flooding as well as rock and mudslides to the region. Peak rainfall in parts of the region expected to reach as high as 1.5 inches per hour. That's according to the National Weather Service. Some LA County residents have already been ordered to evacuate. Israel is warning that it will respond to ceasefire violations from Hamas. Israeli Prime Minister Benjamin Netanyahu's office saying that Hamas continues to violate the ceasefire and President Trump's 20-point plan, and Israel will respond accordingly. This comes after an explosive device was detonated this morning, targeting an Israeli military vehicle during operational activity aimed at dismantling terrorist infrastructure in Gaza, where a combat officer was lightly injured. This is all according to the IDF. The Trump administration imposed visa sanctions on former EU Commissioner Thierry Breton and 4 other people for trying to make American tech companies police political speech on their platforms. The sanctions target activists and nonprofits focused on digital hate speech and countering extremism. The Global Disinformation Index called the sanctions an authoritarian attack on free speech and an egregious act of government censorship. Meanwhile, U.S. Secretary of State Marco Rubio defended the move, saying that the Trump administration will no longer tolerate these egregious acts of extraterritorial censorship.
And let's take a look at more of today's top stories with Michael Ball. He covers global macro, commodities, and much more for Bloomberg News in New York. Mike, thanks for joining us. Let's start with the gold rally, because we hit a record high. We're coming off just a little bit right now. But what's really been driving this latest move higher?
Yeah, I mean, it's the perfect storm. The macro narrative has been there all year, right? It's, debasement, Fed independence worries, lower easing just from what the Fed's already done. Clearly a weaker dollar, as well as sort of all the drivers that had got us sort of to this last leg that we've just seen this exponential move higher. And it's because people are just grabbing. You see it in the option markets, call skew, implied vols, all rising as people are almost squeezing it higher. And this is even more true in silver, which has a greater supply and a less liquid, less deep market for people to speculate in.
I mean, is it the type of thing where people all run for the hills at the same time then? Like we sometimes see with stock moves like this or.
Yeah, Barton, you're right. I mean, when we've had these meme crazes, you've seen call skew, bid, gamma squeeze is higher, and basically everyone that gets shuck out because you're basically buying to something that you need a 20, 30% increase every month to justify. And that's what silver calls are pricing right now.
But that's not good for the market, right? I mean, if that happens, we're going to see huge slides, and surely that will inspire fear in other parts of the market.
Exactly. And it's when you get this one, it's something where you can take a greater risk sentiment read. But honestly, with year end coming, I think you're going to see some profit taking. You already probably are. And people are rotating maybe back out of it into other more traditional assets. Because let's be clear, to be overweight gold wasn't very consensus, and most portfolios don't have large positions in that.
It's really incredible to see the year-to-date gains in silver up 130%. That's basically twice the gold move. So it's not a hedge, right? Like, you don't speak to investors who say, I'm hedging my portfolio, I'm adding this precious metal.
No, it's similar happened in copper as well. It's an inventory issue where there's just a lack of sort of inventory on the global stage, and all of a sudden you have some supply disruptions, and boom, you get people scrambling because you have to have the physical stuff to back the derivatives, and there is some sort of, need to move that either to the U.S., to London, or into Shanghai across all these metals, and that's where you get these squeezes, and that's what we're going through right now. And it's impressive to watch because, to Vonnie's point, you don't know when it's going to end, even if it seems unsustainable.
So gold is one thing, but silver, copper, palladium, platinum, some of those have industrial uses.
Right.
How much of the run-up is, tariff threats and stockpiling? And I mean, obviously China isn't as industrially productive at the moment as it has been in the past, but it's still probably stockpiling copper.
Yeah, well, 2 points there. It's interesting that the actual physical demand for the Chinese industrial needs seem to have come off, so it is a little bit counterintuitive that it's done this well. Silver was a big part of their solar push, and that's sort of slowed, so their actual industrial needs to build solar panels and all that for silver has come off, which has made this kind of really interesting trade and more speculative than actually fundamentally based. But copper itself has had a bunch of supply squeezes, including a large mine shutting down in Indonesia, which was about 3% of the global production. And then, to your point, Ronnie, the real driver is this tariff overlay, and not just for copper, which is still in the flux, but people are talking about things like lithium, silver. Obviously, we know about the rare earths. All of this now are becoming strategic national security considerations that will alter policy moving forward, and that's why there's this premium. And actually, Goldman put out their year-ahead look on commodities and said this is the age of now we're putting premiums on commodities just to secure the supply chains.
What about when it comes to manufacturing, reshoring, continuing in 2026? How does that affect precious metals, particularly the ones in the U.S.?
Yeah, I mean, the precious metal story is going to really be more on the Fed. I think the copper and industrials, like aluminum even higher, tin's getting a recent bin, all that has to do with the reshoring because the U.S. doesn't actually have too much mining capacity, but also doesn't have a lot of refining capacity. So we rely a lot on China, even for things for copper refining and for lithium refining. So these are all big administrative pushes, and we've seen the individual narratives where certain mines or certain names get taken out and get injected with capital from the fiscal pulse.
Okay, soft commodities higher as well today. Sugar, I'm just looking at them. Wheat, they're up as well. Michael, thank you so much, as always, for massive context there. That is Michael Ball. And I do want to point out that we have hit an intraday record on the S&P 500. Surprise, surprise. We're just up 0.2%. But, anything higher is a record today since we closed at a record yesterday. Still ahead, tech trends we're watching for next year. This is Bloomberg Open Interest. Let's get a check on the market now. Well, as long as we stay positive on the S&P 500, we are hitting records because we closed at a record high yesterday. We hit an intraday record just a few minutes ago. Let's take a look at the stocks that are responsible. So we have 336 higher, but in terms of points contribution, Apple, the biggest contributor there, it's up 0.6%. Micron obviously has been doing so well. Broadcom, Costco got an upgrade, and then a couple of the financials doing well as well today. Let's look at the drags on the index. Nvidia, one of the major drags on that index, as you can see, isn't it always? In this case, it's a Reuters report that the Intel chip processor that it was using, it may have stopped using that. So that's dragging both on Intel and on Nvidia. Let's take a look at the sectors that we are looking at because there are many of them that are in the green today, but not many of them are adding that much to the positive feeling. So consumer staples, obviously the best performing sector there, real estate, financials, as I said, and then to the downside, communication services, consumer discretionary, and so on. The economic data not really helping today. Initial jobless claims really just went sideways. Emily.
All right, well, investors will remember 2025 as the year the artificial intelligence rally broadened out and the fears became more pronounced. As we head into 2026, questions are growing around valuations, earnings power, and which part of tech can deliver beyond the hype. Joining us now with what to watch in tech in 2026 is Bloomberg's Ryan Vlastelica. So Ryan, just talk to us broadly about the outlook here for tech in 2026. What do investors, strategists, what do they want to buy in 2026 that maybe was different than this year?
Hey, good morning. Thanks for having me. So I would say as we go into 2026, the big unanswered question is, when is all this AI investment going to start paying off? When are we going to start seeing adoption really proliferate in a more expansive way and companies start seeing a bigger return on all this spending? There's a lot more caution, I think, going into 2026 than there was going into 2025. A lot more skepticism about some of the Mag 7 names in terms of what is their growth pace going to be looking like going forward? Is it going to decelerate? What do valuations look like in the face of decelerating growth? I'd say those are the big issues right now, although there continues to be a lot of optimism about AI writ large and a lot of optimism about all the companies that are sort of connected to the infrastructure side of things, including some of the companies that were big outperformers this year, like storage companies, memory companies, and those parts of the infrastructure play.
Yeah, exactly. And I'm curious about quantum stocks, Ryan, because they had their moment this year and came off, a massive amount. But then just in the last couple of weeks, we saw a massive gain again. And there's talk of the Trump administration taking a stake in some of them. What are you hearing?
Quantum is an incredibly volatile part of the market. It seems like every time we look at it, it's some kind of double-digit move, whether up or down. There's a lot of interest in this space, but it is very speculative. None of these companies are, very big, very profitable. A lot of the technology is still sort of being worked out and unproven. You do have major players like IBM and Alphabet that have their own quantum businesses that are kind of seen as the more, safer plays within the sector. But there is a lot of interest in it, and certainly you hear about if some of these companies do pull it off in terms of the technology, the potential upside is potentially massive. People can say that quantum computing is even more important than AI, but it's a lot less proven.
Ryan, just in the last 30 seconds here, which kind of sectors are most exposed in 2026 to the threat, really, of AI? We have a lot of big AI privately held companies. What public stocks are most exposed?
Well, a major theme of this past year has been software as a service companies, which would be companies like Salesforce or Adobe, companies where there is a lot of concern that AI native companies will be able to kind of swoop in there and take some of that business or have their own sort of AI native offerings that will reduce demand for either seat-based businesses or companies with their own sort of applications that have some kind of AI equivalent. So I think that's going to be a major theme as we continue to look out into 2026.
All right, well, can't wait to have you take us through it, Ryan. We look to you for all of that coverage. That's Bloomberg's Ryan Vlastelica joining us, and thank you. Let's take a quick look at these markets now, because we do have small gains for the S&P 500, a small decline for the Nasdaq 100, really just talking about points at this stage. Coming up, a look ahead to what consumer trends we'll be watching in 2026. This is Bloomberg Open Interest.
Well, for the fourth consecutive month, U.S. consumer confidence declines. The gauge of present conditions sank to its lowest since February 2021, and the 5-month losing streak is now tied for the longest since 2008. The drop underscores the concerns of consumers on issues such as inflation, tariffs, and politics. For more, we're joined by Bloomberg Intelligence senior analyst Jennifer Bartashis. So, Jennifer, just talk about 2026 outlook here. A lot of people talking about the K-shaped economy. How stressed is the U.S. consumer right now?
Yeah, it's actually, we're entering into 2026 with, I think what we're going to see is an expansion of that K-shape. We've got unemployment that's rising. As you just said, consumer confidence is down. Savings rates are slipping. The poll data shows that people aren't that confident in the economy. And yet, when you look at consumer confidence, the higher income consumer is a bit more optimistic, but the lower income feels like they're being left behind. And so we just see that extending, especially in the first half of next year.
Some of this, Jennifer, has to do with the stock market going up, right? And just that feeling that your wealth is getting bigger, maybe your 401k is getting, tougher, and you can afford to spend on these luxury items. I mean, if there was a stock market correction or anything like that, would the luxury part suffer as well?
Yeah, absolutely. That is one of the biggest risks that we're seeing in 2026, is that if there's market volatility and the market does start to go down, those higher income consumers become much more conservative and they pull back on their spending. And right now, a lot of the retailers in the space are counting on those higher income consumers to help them meet their guidance and to help them meet their sales growth goals. And so if that happens, it could spell real earnings pressure for some of those retailers.
When you look at the data, what kind of insights do you have on just how much further consumers, particularly on the higher end, can stomach even higher prices if we were to get another inflationary spike? Do they have that strong stomach for it?
Actually, price sensitivity has gone up across all income cohorts that we track. And so there's still a little bit of appetite from the higher income consumer, yet we're seeing food inflation start to creep back up. If we see that transfer into other material goods, that could really become an issue in 2026. Right now, that price sensitivity just means that people are still really looking for value, and that behavior is really going to extend in 2026. But there's a downside to that, and that means that the more people search for value, the less loyal they are to specific retailers or to specific restaurant chains, things like that. So there's a challenging operating environment ahead for those operators.
Jennifer, thank you so much. That is Jennifer Bortatis of Bloomberg Intelligence. For more now on the second-hand luxury market, we're joined by Rati Levesque, the RealReal president and CEO. The RealReal, of course, the world's largest online marketplace for authenticated resale luxury goods. Well, Rati, you've been doing extraordinarily well at the RealReal, increasing margins, increasing, just the amount that you sell. How much have you been benefiting from things that are maybe a detriment to the economy, like tariffs?
Yeah, it's interesting. So what we're seeing the buyer be quite resilient at the RealReal. We're seeing consumers' trends being quite strong around fine jewelry, watches, handbags. We're definitely probably a tariff beneficiary, but at the same time, there's other things kind of impacting our business. Resale is becoming more mainstream. That's number one, and definitely seeing that led by the Gen Z and millennial consumer. We're seeing fine jewelry and watches be very popular, like I mentioned, gold pricing, silver pricing going up. And then we're also seeing gifting becoming less of a stigma in resale. So almost 60% of consumers now say they prefer the secondary market outright. So seeing luxury and seeing resale specifically becoming much more mainstream right now.
Now, you've been aggressively cost-cutting, restructuring your commission model and so on. Is there any danger that you will maybe not get in the supply that you need in order to keep supplying this market?
Yeah, so, it's interesting. I think that one of the things is that there's $200 billion trapped in people's closets. That's just in the U.S. alone. And so it's such an untapped industry at the end of the day. $80 billion gets added to that every year. So much luxury goods just in the U.S. alone. And so many of these people have never consigned anything before. So we're seeing people become kind of introduced to luxury for the first time. So double-digit new seller growth, for example. So people are really starting to change the way they shop, and they're checking the prices in the secondary market before they're even purchasing in the primary market.
I wanted to talk about prices, Rati, because our very own Amanda Mull at Bloomberg wrote just a few days ago, 2019, the price of a Chanel flat bag, $5,800. Fast forward to right now, it's over $11,000. I'm wondering just how much the growth of the RealReal is coming out of the fact that people feel like they just can't stomach the prices in the luxury market.
Yeah, so there's a couple things happening. Anytime the price increases in the primary market, our pricing goes up too. So for whatever reasons, whether it's tariffs, whether the pricing of a Chanel bag goes up, for whatever reason, our prices go up as well. But like I said, what we're also seeing is more volume coming through. So more people being introduced to luxury and testing it out. And then they get that first paycheck, right? They get that first paycheck for the bag, and then they go back into the primary market. What we're actually seeing is that circular economy. And so they'll go back into the primary market with their check and buy the newest trend or buy something that they've been eyeing, and then they'll consign 2 or 3 things instead. So we'll see that kind of trade up happening as well.
And what are the consumers typically gravitating for on the RealReal? Are they looking for a bargain on a classic luxury item, or are they turning to secondhand markets when they want to buy something trendier?
Yeah, so we're seeing that intersection between value and luxury. That's what we offer, right, at the end of the day. And then you've got very unique items. So most of our items you can't buy anywhere else. So they're looking for those one-of-a-kind pieces. You know, they're kind of maybe done with the trends or everything's starting to look the same. It's the badge of honor to wear something very unique from the RealReal. So think of them like drops. Thousands of items get dropped every day that are very unique to the consumer. So that's number one. Fine jewelry, like I mentioned, watches, handbags, vintage is a big one. As is condition. Again, seeing more of that value play come through. People are looking for that value. They'll take something that maybe is in fair condition instead of pristine condition, just so that it costs a little less at the end of the day.
You know, there are competitors out there now, Fashion File, Rebag, and so on. How do you compete with them, Rati?
Yeah, so, you know, when I think about the RealReal, it's really around, we offer very depth in product, so we don't offer just one category, right? It's handbags, it's jewelry, watches, fashion, textiles, silverware, all of that we're offering at the RealReal. So there's a lot of, and then we give you cash up front, and that's really important, right? Versus trade up or trade in. And then you earn the most with us, and that's really important to say. And the reason why is because of the trust that we build with the consumer. Because because you consign with us, because we've got almost 50 million members now that we've built trust with, because of our pricing algorithms, you can earn the most with us at the end of the day.
I'm curious as well, how much are your physical stores contributing? Are they contributing to the bottom line? And, you know, is it just a marketing play at the end of the day? And when does that bottom line, by the way, turn positive?
Yeah, so the stores pay back very quickly, actually. And what we see is a halo impact. So it's meeting the consignor where they are, whether they want to drop off in a store on their way to work, whether they want a van pickup at 3 p.m. this afternoon on demand, they can book that from their app. And we're seeing the consignor, the seller, consign more items when they interact with the store, and more high value items because they're meeting with a gemologist and watchmaker. So yes, it's a place that people get introduced to our brand. A quarter of our new consignors come from the stores, from our retail locations. But we more see a halo impact. So from the consignor consigning more for us, with us, and then spending more at the end of the day too.
Rati Levesque, CEO of the RealReal, thank you for joining us. Have a great holiday week.
Speaking of which, the RealReal up 43% year to date, so a nice move for that particular stock. Let's get a check on the markets more broadly though, because to look at it on the face of things, we are at a record in the S&P 500, but it doesn't look like there's much happening. Nevertheless, there is. A couple of hours left in trading, and you have some of the consumer names moving higher. Nike, for example, you have some of the memory names moving higher. Obviously, the 10-year yield at 4.15 didn't move much after the economic data. We had initial jobless claims today, pretty much moving sideways. And then, as you can see, the Nasdaq 100, it is desperately trying to finish the session in the green. Coming up, the Trump administration's plan for banking deregulation in the new year. We'll dive into what we should expect. This is Bloomberg Open Interest. Time for our Wall Street Week conversation. Bank of America Chair and CEO Brian Moynihan discusses with David Weston how his firm plans to navigate Fed action in 2026.
We just need our team that's done a great job for us over the last several decades to keep doing it. And what they need to do is go out and get one more client and do one more thing with every client we have. And they know that across all of business, whether it's our markets teams, whether it's our global corporate investment bank teams, our consumer teams, our wealth management teams, all of them need to go out and just drive more business. And that organic growth engine, which we described in our investor day a while back, that is intact. It's been growing with the market. And now, because of some dynamics in the repricing of the balance sheet, we'll get more earnings lift out of it like we did in the third quarter. But that organic growth engine, more customers and more with each customer, has been driving a Bank of America, and our team just needs to do more of that, and they know that.
How sensitive is your performance at Bank of America to what the Fed does on interest rates? I mean, if it actually cuts faster than people think, or it doesn't cut as fast?
Look, at the end of the day, if our team predicts, and most of the economists out there predict, that the Fed funds rate will go from where it is now down closer to 3%. And the debate might be 2 3/4, 3, 3 1/4, but it's a debate. That nominal rate environment from, say, 3% Fed funds rate to maybe a 4, 4.5, percent 10-year Treasury rate. That's a good normal interest rate curve where banks can do well, and our bank can do very well. We have $2 trillion of deposits, and a trillion of those are low interest, no interest accounts. And if the nominal rate environment sits in around 3%, it's a very good environment for our company to grow its earning streams while it's growing its customer and its balances and its deposits and loans.
You recently had Investors Day, and you went through in that your investment in tech, which, as I recall, is $10 billion over 10 years, $1 billion in this year alone. What did you get for that? How do you monitor the return on investment of that kind of tech investment?
Yeah, so each year we have about $13 billion in total tech spending. About 9 or so of it is the running the environment, protecting the environment, and sort of what they call the infrastructure, both the systems and protecting those systems and new software purchases. About $4 billion is what we call initiatives, and that's the new products, new services, the things my teammates love to talk about. And what do we get for it? How do we measure it? We literally look at every project we do and say, what's the payback in terms of additional revenue, or additional expense, or expense taken out of either reducing work or simplicity in the systems environment. So we measured all that. It's got to be above our cost of capital. That's a technical way to measure. But what you really see is that deployment of lots of capabilities to help our customers do much greater things with AI, with agents and all the things we're working on, but also our teammates to do great things. So this year we deployed, our 365 Copilot will finish the end of the year with 200,000 people up and operating on AI, and it's just tremendous. And that's all part of that major tech budget. But also, as part of that is just the nuts and bolts of having a better trading system, or enhancing that trading system, or our data. So that $4 billion plus a year is really important to drive the initiatives that we have as an innovation company.
Brian, as CEO of Bank of America, an important part of your job, maybe the most important part, is managing risk, upside risk, downside risk. As you look at the risks out there, how do you manage, if at all, for the risk that, in fact, we're over-investing in AI as an economy?
Well, I think as an economy, the issue would be if it got overheated and it retracted, what would the impact flow for us as a company more into, consumers, job loss, things like that. And right now we see that as being relatively limited because it's a narrow group of companies, a narrow group of spending.
That was Bank of America Chair and CEO Brian Moynihan. This month, the Senate confirmed new officials to regulate U.S. banking, settling the stage for policy shifts in 2026. Among those confirmed is Michael Selig, who will chair the CFTC. He's already been serving as chief counsel to the SEC Crypto Task Force. That's just part of what's expected to be a new era of crypto regulation in the U.S.
For more, we're joined now by Katanga Johnson. He covers banking regulation for Bloomberg in Washington. So the Genius Act, Katanga, is it a foregone conclusion at this point?
Many banks have really looked to the Genius Act to kind of specify how the regulators will draw the line between what's been a winning year for crypto, but not in a way that causes them, the banks, not be able to compete. I think regulators have the task of trying to comply with the act, making it very clear, the future of stablecoin in the U.S. and even beyond just stablecoin, digital assets broadly, but they have to contend with banks that don't like some provisions of that act. And next year we'll see how they draw those lines and whether they can satisfy both crypto and traditional finance.
What about when it comes to capital rule changes for the big banks? To what extent is this kind of easing of capital requirements a win for Wall Street?
Wall Street banks had long been saying post the crisis, capital rules needed to be calibrated in a way where the system can remain safe and sound, but where banks can actually provide the innovative products that their customers are asking for. In 2026, we anticipate seeing clearer guidance from the banking regulators, but also to see banks sort of deploy that capital to businesses involved in AI, in crypto, and even to help achieve some of the longer term aims of sort of providing more, small business capital, being able to, provide more lending to American potential home buyers and all the rest. I think there are a lot of lofty goals about how banks should be using their capital, but chiefly regulators want to see banks sort of focus on their main risks, but also deploy capital in ways that help boost innovation.
In fact, Katanga, you wrote a great piece about Trump's reordering of U.S. capital, and it is pretty stunning just in this year alone how that all changed. Just maybe give us a brief summary if you could.
In banking, but also in crypto, in the energy sector, we've seen the administration sort of loosen up capital again toward sort of seeing companies be able to deploy it in ways that promote innovation. But while it's common for an administration to relax rules, in a certain cycle, we've seen that traditionally with Republicans. What's distinct about the way the Trump administration has done so is that they're also directing how the capital should be used, particularly in banking, for example. One major rule that's been relaxed is this enhanced supplementary leverage ratio. And ultimately, relaxing that ratio wasn't just to give the banks a win, but to see them potentially be or find the purchase of treasuries more attractive. The administration in direct ways and indirect ways really want to see banks not just, again, loosen rules, but in the case of treasuries, be able to boost demand there.
Bloomberg's Katanga Johnson, thank you for your reporting this year. Keep it up in 2026. Coming up, the battle over healthcare funding looms over lawmakers' return to Capitol Hill in 2026. We'll bring you the details next. This is Bloomberg Open Interest.
All right, now that Congress is out of session until the new year, unresolved healthcare funding around the DOJ's release of the Epstein files as well. All sorts of questions looming over lawmakers' return in January. Joining us now to discuss what we're watching from Congress in 2026 is Bloomberg's Deputy Congressional Editor, Mike Dorning, who joins us live. So, Mike, let's start with the ACA subsidies. It's not resolved. I mean, is it possible we could be looking at another government shutdown come the end of January?
It's certainly possible. I think there's a lot of pressure within the Democratic Party to try to avoid that. But, there's balancing pressure that this fight over healthcare subsidies is something that goes to the core of the party's goals. And they also see it as a political winner. This quest for sort of broader health coverage goes back to Harry Truman in the Democratic Party, and it's been a signature Democratic issue for a long time.
Mike, what are we watching for corporate tax cuts? This is Bloomberg, so, always focused on what the legislation is going to mean for Wall Street next year. Are we expecting more legislation that will help corporate America?
In terms of tax cuts, there's some effort for another so-called reconciliation bill where they can just have a majority of Republicans voted on tax issues and some more corporate tax breaks. That's going to get harder to do as the election draws nearer, and it's going to be an uphill fight.
And of course, we're waiting on SCOTUS decisions and everything, Mike. So there's so many pieces moving around. But this Epstein stuff that just keeps getting released day by day, is that going to continue into the new year? And is it going to make much of a difference when it comes to the voting public?
So it could discourage Trump's core MAGA voters from turning out in large numbers. He's not on the ballot anyway. That's the sort of political stakes there. And it's also an opportunity cost because he's stuck talking about that. That said, it is likely to continue because a lot of the files have been held back. And once the files are held back, you're going to keep on having fights over the files. That's why a lot of times they just dump all this stuff up front to take the hit early on and move on. But this kind of dribble just sort of extends the pain. We'll see. Possibly they could try to take advantage of that time between Christmas and New Year's to dump out all the stuff that's problematic, but that may not be the case. And we already have this question of there were 10 co-conspirators they were going to indict, and they won't say who those co-conspirators were.
Bloomberg's Mike Dorning, thank you for joining us.
Well, Emily, as you know, markets are closed tomorrow. We're going to be seeing you Friday, but we do have still 2 hours left in the equities trading session today and 3 hours left in the bond trading session. If anybody is left out there, we are seeing some gains for the S&P 500. That intraday record within sight again. And of course, we closed at a record yesterday. Above 69.22 right now. Apple, the points leader, and Nvidia, the points laggard, as you would imagine. Micron and some of the chip stocks doing well, the memory stocks doing well, and some of the banks doing well as well. As regards bonds, really not much action. Emily, thanks for joining. This has been Bloomberg Open Interest.